Our next guest is pretty impressed with earnings season thus far, even if the bar has been set low. He's Darren Farwell, Director of Wealth Management at Scotia McLeod. He joins us for this and his top picks. Good to see you again.
Hey, thanks for asking me back.
Okay, so we got a 0.6% gain for the TSX this week. That's a good week in your books?
It's a good week. The momentum's going the right way. Don't fight the tape. The tape seems to be going higher.
Happy with the earnings report so far. Apple hasn't even reported yet.
It'll be interesting. Very happy with the earnings. In fact, what we've seen is 83.3% of the S&P 500 companies that have reported have beat estimates, and there was 65% last time they reported, so that's a nice improvement. And again, the direction's going the right way.
So is the sentiment going to continue to improve? You know, I mentioned the Apple component because we were talking so much about the last quarter and how strong the numbers were, but once you X Apple from the equation, it wasn't as bright.
Well, now we've got companies like Microsoft coming in with very good numbers. We've got companies like Kraft and GE, Coca-Cola all coming in with good numbers. Look, I think the bottom line is that we've been talking for a long time on the show. We are in a recovery cycle, and the recovery is picking up a little steam. In the summer, it got taken off the rails by what was going on in Europe. But you see what goes on in Europe now, all of a sudden the market shrugs that off a few days later and we're going higher. We're in a classic recovery.
At the same time, while we are seeing our recovery continue, the Chinese are pulling back a little bit. You know,
Yes.
We would still, you know, cut off our right arm to get a 7%, 8% growth. Are you not concerned about China? What's the impact of China cooling?
I think the impact on China cooling is a little bit more on Canada prospectively than in the United States. I mean, our commodity sector has rolled over a little bit. I mean, we're a little bit worried about things like copper and potentially oil, and certainly we've seen what's gone on in natural gas. So that's not great for our market. Other things in our market are still good. We're still positive, but that rollover in commodity prices is a bit of a concern, and that's partly because of China.
Okay, so gold, is that expected to give back ground, or in light of the slowing environment, will that be the safe haven play that we so often talk about?
Well, as we've seen in previous recoveries like this, gold tends to hit a peak, which it clearly did back in the summer, and then as risk goes away, it comes down in price. The big thing about gold is not so much right now bullion. Bullion's probably finding a base somewhere around here.
Okay.
Very comfortable with the price. But gold stocks, yes, there are political problems. We've seen that in South America. Yes, there's some management problems with the gold stocks, but fundamentally the gold stocks are trailing the gold by a lot.
Right, and we can see it on the screen right here, whereas the red line is the gold itself, and then the gold index itself is almost, well, is slightly underwater. So top pick number one is in this space?
We want to buy some gold stocks. Right now, we like Barrick as a company to buy to get that gold mining stock, which is at about a 15% discount to the bullion for sure.
But will it catch up?
It will catch up. Historically, it takes, anytime there's been a big gap like we see, there's a 10 to 15 month lag between when that gap first emerges and when they catch up. We've seen it in the past. We think that'll happen again. It's more a matter of time than a matter of whether it will happen.
CIBC World Markets figures Barrick will be $60 in a year. What do you think?
I'd love to see that. I'd like to.
How likely is it, though?
$60 would be a little further than we would suspect. We'd like to buy it somewhere under $39. We'll look very carefully at it under $39. Then if we saw 46, 48, we'd start reviewing our positions again.
All right. Clearly, you like me because your topic number 2 is my boss.
Yes.
Thank you.
Well, I like to be invited back, too.
Okay. Why BCE, though?
Well, as I said, in Canada, we're a little bit worried about the commodity stocks. We're also a little bit worried about what could happen in real estate. We see the Government Bank of Canada say, guys, watch, interest rates are going higher. That won't be good for real estate. Personal debt's too high. Be careful about real estate. So we want to own good companies in Canada that are increasing earnings but pay you a nice dividend while we wait for the broader market to recover.
All right. It is a 5.4% dividend, 54.25 cents. But at the same time, we're seeing in the States evidence that devices like the iPhone are eroding the margins that the industry is getting. Their CapEx, they had to spend a ton of money to take advantage of that device, etc. Are you worried about that spilling over to the telcos on this side of the border and slowing growth in telecom?
It may indeed slow growth in telecom, but we're coming off of, I mean, we're at 12,200 on the TSX. Back in June of 2008, we were at something like 15,200. So whether telcos' margins get squeezed a bit more, when we see that recovery turn into expansion, which is what will come next, all of those companies will go up in price. And while we wait for that, we get a very nice dividend.
All right, on the topic of expansion, you like Pfizer. Why?
Well, we like Pfizer because they've done a fabulous job of their earnings. They've managed the company well in terms of just what the structure is. They've increased their dividends. And when I first came on the show and we were talking about it, $18, $19, they've moved up nicely from there, and we see it going higher still.
Well, it's already up 15% on the screen we're looking at here. How much higher do you anticipate it going in light of its pipeline?
Well, we'd look at it $24, $26 as to whether we want to take a little bit of profit. But it's the kind of company that we like. It's a global company with brand clout that pays a very nice dividend and does business around the world. Love those kind of companies, and we see with companies today reporting that those are all going higher.
3.9% dividend yield, a good 22 cents every quarter, or is it monthly?
Not bad. And remember, they raised it back in the summer.
That's true. Great having you with us again. Thank you so much.
Thank you.
Darren Farwell, Director of Wealth Management at Scotia McLeod. What's your take? Where does gold go from